Hey y'all, Mike back here with another stock strategy video, and today we'll be talking about the top stocks you should buy if you have $5,000. Just a quick reminder that this is not financial, legal, or tax advice. You should make sure to do your own research before you do any investments. Let's get into it. And before we dive into the stocks, just make sure that you click the like button below if you enjoyed this video and took some helpful advice from this. Before we begin, make sure you comment down below. What are your top stocks that you would spend $5,000 on? And what are some of your trades that you would make, both short-term and long-term? So today we'll be covering 5 stocks that you should consider looking into with your $5,000. 3 of these stocks will be well known that you might have heard about, and we'll be taking a look at those. And there will be 2 stocks that are kind of under the radar that you might not have known about. So stay tuned for the whole video to see all of these stocks to make your best decision. The first stock that we have is Visa. So you might know this as the credit card company. The interesting thing to know is that they don't actually provide any debt. This is usually Chase or some other bank that is actually providing the debt. The key thing to note here is that their net revenue is about $4.8 billion, which is actually a 17% decrease from last year due to the pandemic. And the interesting thing to note is their main source of revenue is through data processing fees and service fees. So service fees are kind of what they charge when they process your credit card, but the data processing fees are adjacent to that. So this is when they process your credit card payments to the clearinghouse and all those millions of transactions that they facilitate. So their stock is up about 19% year over year. This is even with knowing that their revenue is down by about 17%. I think a big reason for why Visa stock is up 19% over the last year when their revenue is down 17% is because people are really betting on their infrastructure as their moat in the future. So when they build out their infrastructure and put their technology into payment providers, put it online for anyone to use, what they're doing is they're incurring this one-time cost to integrate. So when you integrate with a point of sales like Square or other types of payment providers, it does cost a lot upfront to integrate that. But after you've done that expensive one-time cost to integrate, all the additional transactions that are done on the payment processor are incremental. So the one thing here is that their infrastructure, they're still building out their infrastructure. They are still investing in it. And even though their revenue is down year over year due to the pandemic, I think this is very short-term and very short-sighted. If you continue looking out on a 5 to 10 year trajectory, I see people using and continuing to use more credit cards. I think more transactions will be online due to e-commerce. And I think Visa is gonna really reap the rewards of their infrastructure. I think the smart play here would be to buy and to hold with an outlook of 5 to 10 years, knowing that this pandemic and this decrease in revenue is very short-lived. I see a lot of potential with e-commerce, and I see a lot of potential with markets who aren't even using credit cards and are still using cash. The next top stock to buy that's probably flying under your radar a bit is Fiverr with a ticker FVRR. So just a quick disclosure, I actually do own Fiverr, so I might be a little bit biased here. For a little bit of reference, their stock is up almost 700% in the last year. Their stock has been insane and the growth has been insane. And so the real question is, can they keep up this growth and can they grow further past their current levels? I really do think the answer is yes. I do think they have strong core growth in their financials. They're growing 80%, over 80% year over year. And I think this is very impressive for a company this size. With a lot of jobs moving online now due to the pandemic, and even past the pandemic, I see a lot of jobs moving online and the future of work changing drastically. A lot of employers are actually looking and saying, hey, maybe we need to hire cheaper labor, especially with tightening down costs. And Fiverr and gig workers are the best way to do that. Instead of hiring a full-time employee to do video editing, you can hire someone on Fiverr for really cheap who can speak decent English and can work really quickly for you on certain projects, and you don't have to hire them full-time for a whole year, right? You can let this Fiverr worker keep on going, or you can end their contract whenever. And I really see this as the future of work, with some of their biggest categories such as video editing, digital marketing, web design, computer programming, And those different types of services are growing really, really fast. And I see them being all digital, and I see them going all remote, and a lot of employers embracing this remote gig worker strategy. And one of Fiverr's big strategies this year and beyond is doing something called going up market. And what that really means is they're trying to get to more premium services and offer more premium types of gig workers, ones who are better quality or can speak better English or can provide better services. And what I see this really doing for both employers and Fiverr is employers will be able to get higher quality, better skilled contractors and replace their full-time employees, not offer as many benefits, but can be very flexible with their contractors, while also Fiverr is making very high quality margins, making a lot of money and building this moat. The next stock that you should really look at is Microsoft. So this is a tried and true stock. Little disclosure, I actually do also own Microsoft, so take that with a grain of salt. So this is a classic stock. It's been up over 55%, and you've probably already heard it, and it's growing pretty fast, especially for a big company that has an over $1 trillion market cap. So this is definitely one that you should have already had on your radar. So they work on everything, but specifically what I think they're really good at, both during the pandemic and outside, is remote work and helping people be efficient in the workplace, both when they're in the office and outside of the office. I think right now with a lot of their services, such as Microsoft Teams, which competes with Slack, to their Dynamic and Office 365 products, which enable efficient collaboration on documents, I really think Microsoft is poised to do really well during this pandemic. A lot of companies are now buying these tools, buying these services to help them work remotely and collaborate with people, not just across the country, but also in different countries, in different time zones. And I think Microsoft is really building both efficient tools and tools that integrate really, really well with each other. And on top of that, they're growing at 13% year over year on revenue. This is huge. For a company this size, they make, $30 billion every quarter, right? If they grow at 13%, that's $4 billion increase every 3 months. That's basically adding another S&P 500 size company to your revenue. They are growing at an insane pace, and for a company this big, this is pretty unheard of. And I really see them poised as the future of the workplace and building all of the right tools to help us work efficiently. And on top of that, some things that you might not have known is Dynamics 365, Azure, and Xbox are growing really fast right now. And so Azure you might have heard of, which is their cloud computing service. They're growing really, really fast just because the whole cloud computing industry is growing really, really fast. But also Dynamics 365 and Xbox. These are kind of unheard of divisions, but Dynamics 365 is kind of competing with Salesforce. It's kind of creating a CRM system to help people work and collaborate and honestly just sell better. And then there's Xbox. You've probably heard of Xbox, but you might not have known is that they're growing really, really, really fast. So the fourth company that I have on my list that you probably haven't done too much research on or probably isn't on your radar is a ticker, TEAM, Team. And this is the company Atlassian. And so just a quick disclosure, I do own Team, so take it as you will. But again, this is a ticker for Atlassian, and they are up over 57% in the last year. And you're probably wondering, what does Atlassian do? They make a lot of online collaboration tools, from Jira to Trello to Confluence. And this really allows a bunch of teams and project managers to work easily together to figure out what is top of mind for them, what is on the backlog, what are the tasks that needs to be done. And so this really fits well into the era of remote work and working with a distributed team. The one thing I would say here is they make a lot of money from subscriptions. So a monthly subscription to Jira or to Trello, and this is usually with corporate customers. So the interesting thing here in their strategy is their churn is pretty low. Number one, because they make really good products. And number two, it's because they have products that have a lot of lock-in. So when you start to put all your information into Jira and Trello, it's really hard to move off of those services. And so what they're really doing is they're trying to get a lot of corporate customers. because they know that this reduces churn. It's really hard for a big corporation like, let's say, Visa to move off of Jira's and Atlassian's systems. And so what this really means is they're spending a lot of money to actually acquire these customers. They spend a lot of money up front to acquire these customers, but they know the lifetime value of these customers is a lot more than it takes to acquire that customer. And just looking at their balance sheet real quick, you notice that they have a decent net loss. However, when they first IPO'd, they were actually making a profit. And now they're really investing in acquiring companies and helping those companies come on to Jira, whether it be through marketing or giving them some sort of sales promotion, or just helping them and giving them the guidance to onboard onto Atlassian's products. And so I think this is actually a really good strategy, both in the age of COVID and the pandemic and long term. The more customers that come on to Atlassian systems, the more lifetime value Atlassian can extract from them. Again, they're paying a monthly recurring subscription, and this is just pure profit after they acquire these customers. And on top of that, we can see these Atlassian customers, they're actually paying more for more additional services. So we know that Atlassian's products are pretty good, and they actually solve a huge pain point for a lot of these companies. They wouldn't add more products and pay more money if they didn't like these products. So we can really see that companies really like and value these products. And that's why I really think the lifetime value of a lot of Atlassian's customers are a lot more than it takes to actually acquire them. So I think they're doing a really great strategy, both now during the pandemic, to help a lot of these businesses and beyond. And so the last big company that I have to recommend if you have $5,000 is Amazon. So you probably have already heard of this company. It's probably already on your radar, but I can't deny the amount of money and the amount of influence that Amazon has. Little disclosure, I do own Amazon stock, so I might be a little bit biased. But just looking at their stock, they're up over 91% in the last year, and they're worth over $1 trillion now. You cannot deny the influence and the power and the amount of money that Amazon can generate. You probably already know this, but the top 3 sectors that I really like from Amazon are their e-commerce retail. So this is just Amazon.com. I really like their plays into groceries and Amazon Fresh. I really see a lot of customers both enjoying that, and I think convenience in terms of grocery shopping will be the future. And then the last big one is AWS, especially with the internet and with the pandemic and the revolution of everything going digital. I really see AWS continuing to have double-digit hyper growths in the years to come. I really see a lot of companies now selling with Amazon. Amazon has aggregated a lot of supply and demand on all fronts in the digital e-commerce sphere to cloud computing. And I really think that during this pandemic, Amazon is the best company to weather through any sort of retail apocalypse. They know that their e-commerce website has so many customers. It has aggregated demand and supply. Customers, their first stop is Amazon.com. Suppliers, they know that they need to sell on Amazon to reach all their potential customers. For all those reasons, I really do think Amazon will continue to grow from here, both not just in the pandemic age, but also in years beyond in the 5 to 10 year outlook. So those are my top stocks that I would invest in with $5,000. Most of them I already have invested in, so I'm putting my money where my mouth is. But comment down below, let me know, do you already own these stocks? Would you invest in these stocks? And if you have other ideas for stocks that you'd invest in with $5,000, let me know.